Are you struggling to trade bearish markets? Today I'll show you how to master the price channel down pattern. This powerful chart setup helps you identify clear entry and exit points, whether you're trading with the trend or catching quick pullbacks. Let's dive in. A price channel down is formed when price action is trapped between two downward sloping parallel lines. The upper line acts as resistance, and the lower line acts as support. This setup tells us the market is in a downtrend, but it also creates predictable trading opportunities. The most reliable trade? Shorting near the upper channel line. Wait for price to test resistance, confirm with a bearish candlestick, then short. Place your stop loss above resistance and target the lower support line. Some traders counter-trade by buying near the support line. It's riskier, but if RSI shows oversold or you see a bullish reversal candle, you can take a long trade toward the upper line. Always keep a tight stop loss below support. Eventually the channel will break. If it breaks below support with strong volume, short the breakdown. But if price breaks above resistance, it can signal a reversal. In that case, go long after confirmation. You can also draw a midline inside the channel. It often acts like a pivot. Price rejection here signals continuation, while support at the midline can push price higher. Always trade with stop losses, use smaller size for counter-trend longs, and confirm signals with RSI, MACD, or volume. Risk management is the difference between consistent profits and big losses. That's how you trade the price channel down pattern. If you found this helpful, hit like, subscribe, and share this with a trader friend. What pattern should I explain next? Comment below.